Good morning. My name is Simon Bonney. I'm a partner in Quantum LLP, a leading business advisory firm in the UK. We focus on helping small and medium-sized businesses manage their way through events, whether they're positive or negative. We undertake a wide range of services from helping owners sell their businesses to helping directors and shareholders navigate their way through challenging times, and where necessary, use formal insolvency processes, whether that be to rescue a business in financial difficulty or wind a company up in an orderly fashion. COVID-19 has had a seismic effect on businesses throughout the UK, and while most are used to dealing with the normal day-to-day issues that arise, the effects of the virus have been far-reaching and will undoubtedly continue to impact companies for months, if not years to come. I'm here to provide some guidance on directors' duties and protecting shareholder value. First, it's worth briefly visiting what those key duties are when managing a company. It's important to remember that when I'm talking about directors, I'm also referring to non-executive directors. Section 170 to 177 of the Company Act deals with the statutory framework, and it states directors must act within their powers, promote the success of the company, exercise independent judgment, exercise reasonable care, skill and diligence, avoid conflicts of interest, not accept benefits from third parties, and declare an interest in transactions and arrangements. It was recognised that directors' duties were going to be severely tested very early on in the crisis, when the government announced steps to suspend wrongful trading provisions. The point of that was to empower directors to take decisions without being overly concerned about any personal liability which may arise by continuing to trade. That's in the context that for a lot of businesses, both those who've been historically loss-making or profitable, the effect of lockdown was to impact the balance sheet and cash flow. The government's put in place lots of steps to help cash flow, but a number of those routes are debt. That secured the short-term cash flow for many companies, and many companies continue to seek support through loans, but it doesn't resolve what happens from here. So what steps should directors be taking to act in accordance with their duties? The key advice is around the effective use of management information. A director's fundamental responsibility and their key defence if their decisions were ever challenged at a later date is to establish that they're making reasonable decisions based on the information in front of them. If that information isn't available, it's much more difficult to argue that the decision was based on sound knowledge. So every business who has been affected should be operating at least a 13-week cash flow forecast. Every business should have a corresponding profit and loss account, and those should be regularly updated. One of the very challenging elements of being a director currently is the uncertainty with regard to what the future looks like. So those forecasts should include confirmation of the assumptions on which they're based, and then alternative versions can be prepared showing the effect if something did or didn't happen. For example, if a director is forecasting in January that they're going to land a big contract in September, should they keep that assumption in their forecast? What would it look like if that big contract didn't get signed? The ability of companies to obtain funding has been significantly increased in the short term by COVID-19 and the government measures that have been put in place. But the exit route for companies from lockdown and the current emergency package is very unclear. Directors need to consider a number of factors in their ongoing strategy. Firstly, has the company's business model changed beyond recognition as a result of COVID-19? And is that a good or a bad thing? For example, some overheads may have been cut as directors realise they don't need the same premises cost or possibly the same level of staff. Secondly, is the company insolvent? If it is on either a balance sheet or cash flow basis, then how's that position going to be resolved? Directors' duties will change from acting in the best interest of shareholders to creditors, but that doesn't mean shareholders are no longer a concern. A further funding round from shareholders may be key to ensuring that the company continues on a strong platform, and directors should continue to engage with shareholders to update them on the affairs and the management of the company and provide updates regarding funding required to continue trading if there are ongoing issues. Thirdly, if the company does have further cash concerns regarding CBILS loans or other support, what's the capacity of the company to raise funds, either through debt or equity? What's the appetite of shareholders to inject further funds into the business as it currently is, bearing in mind the economic uncertainty which may have a material effect on financial forecasting. So taking those matters into account, directors will need to consider what steps need to be taken to protect the business and ensure it survives. Depending on the effect of the balance sheet, it may be that whilst the business is sound, the company's taken on too much debt to attract further funds through equity. So if funds can't be raised, what can be done? One option would be to restructure the balance sheet, either to protect the ongoing business or as part of a wider plan to raise funding. So for example, if you've got a balance sheet of a company that's been adversely affected by, say, £500,000 as a result of COVID-19, and most of that's non-critical debt such as loans or HMRC debt, then what steps could directors take to try and preserve value in the business? A business could look to make an offer to creditors through a company voluntary arrangement or CVA, a formal arrangement to try and deal with the debts of the company. It could be that creditors are offered 50p in the pound in full and final settlement of those outstanding debts, and investors have confirmed they're willing to inject funds to meet those payments, but only if creditors accept the terms of the CVA. A process like a CVA is not straightforward, and the success of each one depends on its own unique circumstances. But the key is that for most businesses who've encountered difficulties, it's an option which is available. The key aspect for shareholders is that if a CVA is successfully implemented, the business, the company, and therefore the shareholder structure will survive. Likewise, administration is a tool which may be used in order to rescue a company as a going concern and therefore preserve shareholder value. Whilst we're used to seeing administrations being used to effect the sale of businesses out of the company, therefore usually destroying the shareholder value, it's more likely that they'll be used over the coming months and possibly years to restructure and rescue companies who were proceeding well if it wasn't for the effects of coronavirus. Finally, it's important to note that one of the key elements in dealing with a business under stress is the presence of a secured creditor. Where a company has historically raised money through equity, the granting of security to a creditor to raise loans should be treated with caution. The effect of the security is that the lender will be able to call their debt in the event that there's a breach of the facility, regardless of whether that breach is technical. And that lender may exert a significant influence over the company's ability to restructure in the best interests of all stakeholders, including shareholders. So for me, there's always two aspects to keep in mind. Firstly, ensuring that you have the management information available to assess the company's options. And secondly, that good professional advice is sought to ensure that directors are able to consider all options when looking at the best way to tackle future challenges and ensure the success of the company. Thank you.